Welcome to the deep dive. Today, we're taking a closer look at SoundHound AI, that's ticker SOUN. Specifically, the reaction and the details around their first quarter 2025 earnings report.
Yeah, there's been some movement there.
Definitely. We're working mainly from an analysis by the Motley Fool today. They've done a good job breaking things down.
Okay.
And our mission for you listening is really to understand, why the stock dipped, what are the key numbers telling us, and maybe what clues this gives us about SoundHound's future.
Sounds good. Where do we start? The market reaction.
Let's do that, because the reaction was pretty immediate, wasn't it?
It was. The article points out a pretty sharp drop, 7.8% on Friday, May 9th.
Right after the earnings.
Exactly. And it shows just how sensitive the market is to these earnings reports, especially for tech stocks like this.
Absolutely. And it seems like the main trigger, according to the source, was the revenue number.
That's right. I mean, on one hand, you saw this massive year-over-year jump, 151%.
Huge growth. It went from, $11.6 million last year to $29.1 million this quarter.
Yeah, impressive jump. But, and this is the key part, Wall Street analysts were expecting a bit more. They were looking for $30.4 million.
Ah, okay. So even though it grew massively, it just missed that specific target.
Exactly. And in this market, particularly for companies priced for high growth, even a small miss relative to expectations can spook investors a bit.
That makes sense. Expectations are everything sometimes.
They really are. It signals maybe the growth isn't quite as explosive as hoped.
Okay. So top-line revenue missed. But the article dives deeper, right? What about other financials, like profitability?
Well, the adjusted loss per share actually came in right where analysts expected at 0.06 cents.
Okay, so no surprise there on the adjusted side.
No. But then you look at the GAAP numbers, the generally accepted accounting principles and things look dramatically different from last year.
How so?
Well, GAAP operating income flipped from a loss of about $28.5 million to a gain of $128 million. And GAAP net income saw a similar swing, from a loss of $33 million to a gain of nearly $130 million.
Wow. Oh, okay. That sounds like a massive turnaround. What's driving those GAAP gains? Is it core operations?
That's the crucial question. And the article flags that, no, it's largely due to non-cash gains related to acquisitions they've made. It's accounting stuff, not necessarily a reflection of the core business suddenly becoming hugely profitable.
Gotcha. So accounting rules making the numbers look good, but maybe not the underlying business performance itself.
Precisely. And that's why analysts, and frankly you, should probably focus more on those adjusted numbers. They try to strip out those one-off items.
Okay, so let's look at those adjusted figures again. The adjusted net loss, it actually got worse.
Yeah, it widened slightly by about 10%. Went from a $20.2 million loss last year to a $22.3 million loss this quarter.
So despite meeting the per-share loss estimate, the total adjusted loss grew.
Correct. And the adjusted loss per share only narrowed a tiny bit, from 0.07 cents to 0.06 cents. So the story there is still one of unprofitability on an operating basis.
Right, and this really brings those acquisitions into focus, doesn't it?
Absolutely. They're clearly boosting that top-line revenue growth significantly.
But the article raises a good point. We don't really know the organic growth rate. Like, how much are their original products growing without the help of the companies they bought?
Exactly. That lack of clarity makes it harder to judge the sort of fundamental health and momentum of the core SoundHound offering.
It's, like you said, it's hard to know how much is the original engine versus the booster rockets they added.
That's a good analogy.
But there is a positive side to the acquisitions mentioned, right? Something about customers.
Yes, diversification.
Mm-hmm.
Because they've acquired companies, they've also acquired their customers. Now, no single customer makes up more than 10% of their revenue.
Okay, that's definitely a plus. Spreads the risk.
It does. Less reliance on any one big contract.
So what about their cash situation? Are they burning through money quickly? Or do they have some runway?
That's another key area the article covers. And actually, the news there is, relatively positive. Their cash used in operations was $19.2 million in Q1.
Okay. Is that good or bad compared to before?
It's an improvement. Last year, in the same quarter, they used almost $22 million. So the cash burn from operations has slowed down a bit.
And free cash flow. Similar trend.
Similar improvement. Negative $19.3 million, but that's better than the negative $25.7 million last year.
So they're spending less cash overall. How much do they actually have on hand?
They ended the quarter with $246 million in cash and cash equivalents. And importantly, no long-term debt.
$246 million. Okay. So if they keep burning cash at this slightly improved rate, how long does that last them?
The estimate, based on the current burn rate, is around 12.7 quarter.
So it's over 3 years?
Yeah, a little over 3 years. It's a decent cushion. It gives them time, theoretically, to execute their plan and reach profitability.
Okay, that does sound like a fairly stable financial position for now, runway-wise. What's management saying about the path forward? Any comments from the CEO or CFO in the article?
Yes. CEO Kwevan Mohajer talked about their new complete AI agent platform. He highlighted the potential to cross-sell and upsell services, especially with the new customers from the acquisitions.
Makes sense. Leverage those new relationships.
Right. And the CFO, Nitesh Sharan, he reaffirmed their full-year revenue guidance for 2025. They're still projecting $157 million to $177 million.
Which represents a pretty substantial growth for the full year.
Very substantial. About 85% to 90% annual growth.
Again, need that asterisk about acquisitions, especially Amelia.
Exactly. The article notes that Amelia in particular is a big driver of that projected growth.
And what about profitability? Did management comment on that target?
They did. They're sticking to their goal of achieving positive adjusted EBITDA by the end of 2025.
Okay, end of this year. Now, haven't they set profitability targets before?
They have. The article reminds us they initially aimed for positive adjusted EBITDA back in Q4 of 2023.
And they missed that one.
They did.
Yeah.
So investors will likely be watching very closely to see if they can hit this revised target by year-end 2025, especially considering how much might depend on integrating Amelia successfully.
Right. Which brings us to the analysts take the Motley Fool's perspective. It sounds like they're a bit cautious.
I'd say cautiously observant. They seem to suggest that while the company and the voice AI space are interesting, the stock might have gotten a bit ahead of itself, a little overhyped perhaps.
Okay. What are their main concerns based on this report?
The article lays out basically three key concerns. First, as we've discussed quite a bit, the heavy reliance on acquisitions for growth.
The organic growth question again?
Yes. It obscures the core strength. The lack of a clear organic growth number is a big flag for the analyst.
Makes sense. What's concern number 2?
Still profitability, or the lack thereof. The fact that they missed the previous target and the uncertainty around whether hitting the new 2025 target depends heavily on the recent acquisitions raises questions.
So is the core business getting closer to profit, or are they just buying profitability?
That's the underlying question, yes. And the third concern.
Competition.
Exactly. Conversational AI is a hot space. You've got big tech players moving in, especially in the automotive sector where SoundHound has a foothold.
Any specific competitors mentioned?
The article specifically calls out Cerence, ticker CRNC, as another company to watch in that automotive AI voice space.
Okay, so increasing competition adds another layer of risk.
Definitely. It puts pressure on pricing, innovation, market share, all of it.
So putting this all together, the revenue miss, the acquisition impact, the cash runway, the profitability questions, the competition, what's the sort of key takeaway for you, for the listener?
I think the article advocates for a balanced view. Keep an open mind about the potential. Voice AI is a potentially huge market, but temper that with healthy skepticism.
Skepticism about what specifically?
About the reliance on acquisitions, the timeline to actual sustainable profitability for the core business, and maybe the current valuation of the stock, given those uncertainties. The growth numbers look good, but you need to look under the hood.
Okay, so let's recap quickly. SoundHound's Q1 showed really strong revenue growth, but it wasn't quite enough for Wall Street, leading to that stock drop.
Right.
Acquisitions are fueling a lot of that growth and helping diversify customers, which is good, but it makes seeing the core business's health a bit murky. They have a decent cash runway over 3 years, but profitability is still elusive, even though management is guiding for positive adjusted EBITDA by year end.
A target they've missed before.
Right. And all this is happening while competition in the AI space is heating up.
That sums it up pretty well. It's a complex picture.
Definitely. Which leads us to maybe a final thought for you to chew on. Given how fast AI is moving and how fierce the competition is becoming, what metrics or milestones, perhaps beyond just the headline revenue growth or even adjusted EBITDA, should you really be tracking to get a true sense of whether SoundHound AI has what it takes for real long-term success in this space? What truly signals sustainable advantage?
That's the multi-million-dollar question, isn't it?
Yeah.
Something to definitely keep thinking about.